So in this video, I'm going to go through 3 approaches to calculate your investment return, your portfolio return, so then you truly understand what is the return you're getting for this year or multiple years for your portfolio. And the surprising thing is, most people cover the first or the second approach, but I haven't seen anyone cover the third approach. And that is probably the hardest and also the most accurate. And the third approach is actually how a mutual fund does their accounting and calculate their return. So make sure you stay till the end so then you really understand how to calculate your own return over time. So let's get started. 96.4% of you guys are not subscribed yet, so it would be a great help if you can just tap that subscribe button. It is free and you can always change your mind in the future. Make sure you stay till the end for the giveaway as well. In Investing Accelerator, I just want to celebrate the 99th case study where Carolyn made 20% from Shake Shack in 9 months. So congratulations, Carolyn. And this month, I'm looking to help 20 professionals without a financial background to master investing and target 30% a year. The stretch goal is 30 people, and there will be more details at the end of the video. So the first simple approach is really calculating your return on stocks. And everyone pretty much covers this, and you can find it on YouTube. Now the second approach is really to calculate multiple years of return, including dividends. Now sometimes I've seen some videos cover this at a relatively high level. Now the third one is the return on your portfolio, including adding money. And this is probably the most important because adding money does affect your investment return. And so far, I haven't seen anyone actually covers this. And this is actually how a mutual fund calculates the fund return. Before we even start, I just want to say the best way to calculate your own return and to skip all the math is to choose a broker that will do the calculation for you. So I'll jump into my portfolio, my broker, which is TD Canada, and I'll show you how they calculate my return right now. Now here you'll actually find my TD Canada login screen where I actually logged into my portfolio, and it is actually under accounts. And if you have TD Canada and it's under performance, and it will actually bring you to this screen. So when it comes to finding your investment return, it's under the performance tab, and I use time weighted return. That is the one you're looking for. The personal rate of return, I don't know how to calculate it, but that is not what you're looking for. So time weighted return, and then afterwards you can choose the period. So for myself, I really like to look at the long term. So I would actually go all the way over here and choose since inception. And that will probably give you the best idea on what your return is. And then afterwards, you would choose all accounts. So in this case, you can see that for my TFSA and my RSP account, my time weighted return, which excludes any influence of adding capital in, is 684%. And then afterwards, it also calculates my annualized return to be 51.4%. So that's actually very helpful. So you don't need to go through all the calculations yourself. But if you're like me where you have multiple brokers or multiple accounts and you need to calculate this return yourself, then the rest of the video is for you. Now, when it comes to looking at this return, you also get to compare with a target that I set, which is, for example, 30% return, and this is the blue line here. And you also get to compare with S&P 500 and also Toronto Stock Exchange Composite Index. So these two are the red line and the dashed blue line you see below. So my portfolio started really January 2016 and now is January 2021. So first, the simple method. For the simple method to calculate an investment return is basically the money you get divided by the money you put in. Very simple, -1. So let's take an example. You invest in Google $100 and at the end of the year, you get $130. So the market value is 130 divided by 100, and then afterwards, you -1. So that gives you 30%. And this assumes you to hold for 1 year. And obviously, this is accurate when it is 1 year. But if you do this across multiple years and you divide it, let's say 5 years, then the return you're calculated is actually not compounded. But this is the easiest way to calculate a 1 year return. So we're going to breeze through that and go to the medium approach. Now, the medium approach includes dividend and multiple years of return. And the formula is the money you get, which includes the market value as of today, plus the dividend you get, divided by the money you put in. And then you would take that one divided by the number of years. And this will give you your annual return per year for multiple years. So let's go through an example. So let's say in the beginning of 2021, you put in $100 and you get dividend of $10, and you also sold the investment for $150. So you have a gain on investment and also your dividend. So let's say you sold it within 180 days, so it's half a year. So when you think about that, you would take your 160 divided by 100 to the power of 2 and then minus 1. So the next slide, I'll actually show you the formula, and you can see the blue cell, C8 divided by C3, the red cell, and then to the power of 1 divided by the purple cell, which is 0.5 minus 1. So if you want to replicate this within the Excel that you're using to calculate your portfolio return, then you can do so now by pausing this video and studying this formula. And this is a fairly simple way still to calculate your return. And when you put money into your portfolio, that actually influences your return as well. And that's why you need the third approach to calculate your investment return. Now, this is really the hard method, and this is the most accurate method, and this is actually how a mutual fund calculates their return. And this basically separates out the effect of adding money into your portfolio. Now, you might ask, why is it so important to separate the effect of adding money into your portfolio? So I'm going to first show you the incorrect way of doing it, and what happens if you don't do it the hard way, and how that influences your return, so then you better understand how to do it correctly. So first, the wrong way. So the wrong way to do it is really the market value today divided by the amount of money you put in, regardless of which time you put in, to the power of 1 divided number of years minus 1. So this will actually underestimate your return. And here I have prepared an example for you. So let's say this year you put $100 into a stock you like, Google. And the next year, you also put in $100 into the same stock. And by the end of the second year, you sell it. And let's say you sell it for $234. And the way I come to this $234 is that in year 1, the stock grew by 11%. And in year 2, the stock grew by 11%. So if you try to calculate, the investment for your first $100, it grew by 23%. And your investments for the second $100 should grow by another 11%. Then that's how you get to the $234. Okay? Now, when you are thinking about your annual return and you use the formula I just showed you there, it actually assumes you invested all the money in the beginning of year 1, even though $100 is in year 2. So that will get you an annualized return of 8% you see here. And you know that is wrong because in year 1, the gain was 11, and in year 2, the gain was 11 as well. So the annual return should be 11% for this portfolio. And in order to fix that, you will need to separate out the effect of adding money into your portfolio. And this is how a mutual fund or a hedge fund does it. So first, out of your portfolio, you need to separate out, let's say $100 to track your return, and you need to calculate an ownership percentage. And for step 2, every time you inject money or you withdraw money from your portfolio, you need to record the market value today. And then step 3, you add the money you injected into the portfolio and then update the ownership percentage. And then over time, your $100 will not be influenced by the amount of capital you put in, so then you can calculate your true return over multiple years. So let's see an example and see how that works. So here you'll see the table, and step 1, I put in $10,000 in the portfolio. And here you will see the total column, which says $10,000. And the left column, you'll see remaining $9,900 because I've separated out $100 as a constant. So that is relatively straightforward. And when you're trying to calculate the percentage, you'll see that 99% is all and 1% is considered to be the 100. So if you're investing in a portfolio that has 100,000 or a million, you just do the same thing. Just separate out $100 for tracking purposes. Now, step number 2 is really the market value today. And let's say my portfolio grew by 10%. So now it's $11,000. So what I'll do is, using the same percentage I calculated in step 1, I'll apply that and calculate the market value today for my $100 and also the $9,900. So it turns out my $100 grew by 10%, so it was 110, and that makes sense. And then the remaining portfolio grew to $10,890. Okay, so you're following me so far? And at this point, you then inject capital by adding $5,000 into your portfolio. So that brings your remaining portfolio to $15,890. And what you will observe here is actually the constant remains at $110. So that means injecting capital actually did not influence your return because it all went to the remaining column. And at this point, you'll take the total, which is 16,000, and you'll recalculate the percentage. So on the very last line, you will see that it is 99.31% now, and the constant percentage becomes 0.69%. And that is exactly how a mutual fund would calculate it. And as you can see, the steps, you'll need to know the market value every time you put money in. And that is very crucial because that actually gets you the most accurate return. So if you don't want to do all of this, then it's better to get a broker that will do it for you. And for myself, I use TD Canada. When I'm investing, my vision for myself is really to get 30% a year. And this is like going to Mars initially because 30% is such a stretch goal. And that's why I put together a free 4-hour training on how I mastered investing and how I've gone from a person who's losing money year after year to a person who can make 30% a year. So this is perfect for you if you're a full-time professional with no financial background and you want to learn how to manage your own portfolio with confidence. So the link is in the description. It's 5minuteinvesting.com/free case study, and it outlines my journey from going to a loser, losing more than 10% a year, to making 30% a year using a simple, proven, and effective investing strategy. So it took me 8 years to figure this out on my own. So if you're new to investing, definitely check it out. And it is quite long because I put a lot of content in it, and it will put you miles ahead of consuming another 100 YouTube videos. And throughout my coaching career, I have helped Carolyn to make 20% from Shake Shack in 9 months. So that is the 99th case study within Investing Accelerator. And this month, I'm looking to help 20 professionals without a financial background to master investing and to target 30%. The stretch goal is 30 people. So if you attend the free case study in the first link of description, and you can schedule a call with me to chat to see if you're a good fit. Now, in terms of the giveaway, I'm planning to give away another copy of Sam Walton Made in America. So if you just take a minute to like the video, leave a comment below, and I'll announce the winner in 1 to 2 months. So the winner from a previous video is Fred, and he won the book Harmonic Trading 2. So Fred, if you're watching this video, then make sure you send me your details and I'll send the book your way. So that is pretty much it for this video, and I'll see you in the next one.